Hi guys, thanks for coming to our weekly meeting today. We start with Present Scholar. So for month today, we outperform the benchmark, but overall quarter today and year today, we underperform a bit. Jordan, could you comment on that a little bit? I know you wrote about the commentary for our last quarter report.
So for this past semester, towards the end, we really got crushed in our consumer team, our consumer securities discretionary. We met our objective of hitting that 75-25 asset allocation, but then the reason for that was it was just such an uncertain environment. We didn't know what direction things were going. So with this new team, we kind of have more of an idea of where things are headed, especially with the Fed. We have a much clearer picture now, and we decided we wanted to take more of an aggressive stance. So we want to raise it back up to 80% equity and 20% bonds.
And we also increase our duration because our duration only 65 now. We think it's a little low, and we actually gonna execute both objectives in one trade. We have a top bond fund, which is about 5 to 6% of our portfolio. By selling that position, which is only 1.8 years duration, we can increase our average duration, and at the same time, we're gonna bring that 5% to equity. So by selling Thomson bond fund, we can increase our duration and add more to our equity position. So we meet two objectives with one trade. And we try to produce a 7,000 scholarship for some lucky students. And that's it for Present Scholar.
So for the equity portfolio, we're going to talk about two things in this meeting. First, the Q4 performance for the equity portfolio, and also some of the objectives that the new equity portfolio manager team has. So let me go ahead and talk about the objectives first. So some of their objectives were to consolidate all the small positions which are in the portfolio right now. The other one was to rotate healthcare stocks into energy, into the energy sector, and also to add positions to REITs because the equity portfolio does not currently have any REIT positions, I think. And then I would like to hand it over to the equity team to talk about the Q4 performance and just elaborate more if they have on the objectives.
To speak about one of our holdings within our performance is the biggest laggard happened to be PayPal. And this was due to their attempted merger that didn't successfully go through, as you know, been blocked by antitrust, and it wasn't right for shareholders, so it wasn't pursued. So PayPal has been hit hard by this, and there was the reason why it was the largest laggard. Also, some companies that did really well in the performance was Accenture. Accenture was one of the biggest top three performance that I added into our portfolio. And John and Mir, do you want to add anything from there?
One of the things that we are looking into as well is trying to capitalize on gaming stocks that haven't yet had any major catalysts. One of the things that we are looking forward to is a potential swap between our Activision position and Nintendo. We think that as an ADR, it is a bit slept on, for lack of better terms. But we do think that preliminary research that we had done beforehand during the Activision sell process last semester, it had intrigued us, and we are open to looking more into it.
Yeah, and to add on, so other companies that are like small positions, in addition to Activision, which Amir just mentioned, includes Nike. So this is just kind of preliminary, but we're thinking about selling Nike and potentially swapping it for Starbucks. And for points, so I just want to reiterate that we're going to utilize like a blended top-down, bottom-up approach. So we're still working on deciding which sectors to overweight, underweight, or equal weight. But just to provide some colors. So for like the consumer discretionary sector, our top-down views that we're a little bit cautious on the like slowing economy. So consumers will have like less cash to spend, but at the same time, we're still significantly underweight the sector. It is our biggest underweight at around 4%. So we do think that there are still some bottom-up reasons to purchase companies in the sector that, for example, are like undergoing temporary issues. So, potentially like elevated supply chain related costs. So overall, we're more cautious on the sector. So we're probably thinking about underweighting, but we still think that there are bottom-up reasons to increase exposure to the sector. So overall, we still want to increase our underweight, potentially more to like an equal weight position.
Well, thanks, Equity. So unfortunately, bond team, our slide was deleted, so I'm going to switch my share really quick. All right, so not much has happened since we talked last week, other than the bond team is still looking to trim down some of our fund positions, especially those that are coming in at anywhere from 7 to 9% of our portfolio, and look at other high yield funds or high yield positions due to our high yield bonds being called away over winter break. Currently, we are very underweight in high yield. Our benchmark doesn't have any high yield, but we are lower than we'd like to be. We want to take that up to around 10, 15%. We'd also like to increase our duration to around 75 to 80% of the benchmark. And pending the L3 Harris and Charter bond execution, which we will have data for in the next week or so, we should be right in that range. Overall, for the past, we haven't outperformed too much, only by 7 basis points. So we aren't currently at our 50 basis point goal. But for the 1 month ending December 2021, we outperformed by 46 basis points, fairly highly attributed to our duration as well as our credit quality. And I'm going to switch back over to our normal slides. All right, so now onto the tech team.
The last 2 months have been really kind of bad, but then we've seen kind of a recovery in the last 3 days. But then again, more emphasis on PayPal, given that they had their earnings today. And if Tuan, you wanted to talk about a little bit about the earnings and why they tanked.
So let's go back a little bit before this quarter. So last quarter, they missed their revenue expectation and also user base. So, and then this quarter, they missed earning report. So it keep going down, and also they expect for next quarter also low earning per share. However, one good thing I see in their quarter report is their total payment volume is grow to 1.25 trillion, up from 900 billion last quarter. It's like about 30% growth. And for some company like PayPal, the more total payment volume they have, the more it's good for them to grow their earning. So I still believe in the future of the company. There's still a lot of room to grow for electronic payment, and the company bring out a lot of new product last year alone. So I think we should add more to it if we have funding.
So are you still on track to buy more? I don't think the President Scholars has PayPal, but are you planning to add that to President Scholars still?
Yeah, when we have the money.
Okay. Yeah, and then the other holding that I want to discuss was NXPI. They had their earnings too yesterday. And Nick, if you wanted to talk about that.
Yeah, so NXPI, it is an approved trade for equity. It is still in limbo because of a funding source. We are looking for the Accenture sale. I believe Andy's going to be working on that one. But they announced earnings yesterday with automotive revenue up 24%, as well as providing really solid guidance with above consensus expectations for the next fiscal year. Really, they've noticed that most of their COVID-related supply chain issues are mitigated because of their reliance on themselves for manufacturing, but they are still seeing some shipping delays in terms of raw materials, as well as international shipping, just to get products to their final destination. I wrote the report on it. I'm still very bullish on it. I believe it's a good buying opportunity. So we really just have to secure that funding source. But now I want to turn it back over to some of our, is it time for us to sell some of our top performers and buy new positions? Or should we hold on to these top performers? Tuan, Andy, what do you guys think?
That is a very tough question for me. We have our top performer in President Scholar, which is Apple. Among all the technology stock, Apple still perform very well, haven't been down yet, and they still have a lot of good future. I think they plan to release their VR and AR headset this year or next year. However, we never know. So Apple could be a potential sale to fund something new.
Okay, and then I guess we've already answered this question. So what are we going to do with some of our laggards? I know for PayPal, we are looking to add more for President Scholars equity team. Would you guys have any idea on what you'd like to do for some of the technology laggards if you guys are looking at holding, or if you would consider adding to these positions?
Currently looking to hold PayPal as well. We're not sure if we want to increase the weight given that current circumstance, but at the way it's at, because we already had a added report recently earlier on in December. So we're going to stay at its current weight.
All right, thanks, guys. And then we just wanted to end with the overall tech did really well in the past 2 weeks. Excuse me, my dog is barking. But really, it's been due to the volatility index coming down from what we've seen, as well as big earnings calls. Microsoft, Apple, most of our tech holdings have announced their earnings in the past couple of weeks or coming up next week. It really is going to be for us to monitor these and see if this recovery is sustainable. Currently, we think it is, but as more of the data comes in and more of the calls are finished, we'll be able to give a much more an answer with much more sustenance behind it. And let's move on to healthcare.
Yeah, so I think we only have Chris here, or is he even here? Yeah, he is. All right, so it's all going to be Chris for healthcare. Yeah, so healthcare sector just underperformed S&P 500, I think in January. And also Intuitive Surgical announced Q4 results, and they slipped after beating expectations. So Chris, do you know like the reasoning, or what are we going to do with the stock? I think that's in the equity portfolio, Intuitive. Or like, what are you thinking about that?
But just in case, so Intuitive Surgical, I'm not too sure, but Health Equity, they are up 14% year to date. So I know we had a sell recommendation in the pipeline. However, they presented at the JP Morgan Healthcare Conference at the beginning of January and announced that they are expecting record sales for health savings accounts and other other savings vehicles that they use for healthcare. This is kind of an open opinion for everyone. Do you think we should sell this company now that they just announced some record guidance?
On Intuitive, I know it's very volatile. It's a good, promising company. We probably need to revisit it a bit, but I think if there's a better idea out there, I don't think me and Freddie we'd be open to like creating a sell report, because I know it's promising, but it's just too volatile. And if there's something better out there, I think it's a better option. And I think that would also go for Health Equity. Health Equity, I never liked it, but we'll see what to do about that, as well as LabCorp in the President Scholar portfolio. So yeah, we're just going to be reviewing the healthcare positions one by one, and we'll try to get a better opinion on each of the positions. But ISRG is open to open funds for a better idea.
All right, and then I guess just to finish us off for healthcare, are you guys currently working on any new ideas or anything that you guys are just maybe giving preliminary research to?
Not at the moment, but we hope to try to find something by the time we meet up this weekend.
Awesome, thanks. So comp services, communication services, I just call you guys the industrial teams, but T-Mobile. So what's going on with them? We couldn't really find anything, but we know that they're a big laggard. They're down 33%. What do you guys think we should do?
In all honesty, I think we should probably sell. I'm not sure if maybe we should wait for a little bit of recovery. I know they come out with earnings tomorrow, I believe, if I saw correctly. So we'll see what happens tomorrow. I did do some research just to see what's kind of happened in the last 6 months with them. So there's a huge lack of catalysts when it comes to T-Mobile. They do have the biggest network when it comes to 5G, but when it comes to everything else, they're kind of lacking. Their postpaid subscriber additions are shrinking. Their operating margins lag both AT&T and Verizon. Dish, which is one of their biggest customers, signed a 10-year network service with AT&T, so they don't have that business anymore. Like I said, one of their only big advantages is 5G. They also acquired Sprint, but we are seeing a lot of those Sprint customers kind of move actually towards AT&T and away from T-Mobile. Another thing to keep in mind is that 5G dependence is kind of reliant on new consumer apps and software and things that actually allow them to utilize that 5G network that they have. Because if people aren't coming up with stuff that utilizes that software, then it kind of doesn't matter Like, what's the point in 5G if people aren't coming out with stuff to use it? So that's something we also have to look at. Like, are people actually making stuff that T-Mobile can utilize that software for? So I think there's just a big lack of catalysts, and I think it's probably time to get rid of it.
Okay, thanks for the insight. And then I guess Disney and Netflix are kind of hand in hand. Netflix is actually up pretty well after their earnings, and Disney, I'm not too sure, but we have seen a little bit of a buying opportunity. What do you guys think about these two? So add, hold, what are we thinking?
For Netflix, kind of really depends on what they decide to do, but I think there is, despite the, I think there's still options out there for Netflix, especially in the international sector. Not sure if it's like for every other country, but I know, I think in France, they have to spend a certain amount before, like, of the revenue they generate on like international programming. Well, for them it's local, but for us it's international. So I think in the international markets stuff, room to grow. They could also introduce a lower price, with like ads, but it just depends on what Netflix decides to do. So I think it wouldn't be too bad because Netflix is not going to go anywhere. It's just got beat down because of their subscription pressures, but I think Netflix still has options out there. Just need to announce them.
Yeah, and
I agree. Sorry, were you gonna
No.
say something, Andrew?
go for it. You can go first.
Thank you. I agree. A lot of the sentiment that we had as a sector team last semester, I think it remains in regards to Netflix. I think that we do still remain bullish, as per our last conversation that we had over the weekend. There are still catalysts on the horizon that we do like. One of them being the international expansion. I still think that there's a lot of untapped markets out there. I do think that the increase in the premium subscriptions is not the best thing, I guess, going forward, but I think that it's warranted due to the inflation that's also amongst us. But one of the major reasons why I think that we do want to keep holding on to it is because the fact that they're still building that gaming platform that they want us to have. They're the king of streaming, and I don't think that Netflix is going to sit on their hands and be idle about all these the pressures of like Disney and other streaming services. They're gonna, as a pioneer in the industry, they're gonna want to keep maintaining that their presence, and I think that they know that they have to do that, and I think that they will. Streaming and gaming is the next step, and I think that they'll be the ones to be able to take the reins. Even though Google sort of is doing that with their gaming platform that they made, that hasn't been a hit at all, and I think that Netflix will be able to be the one that actually does do it. They have an app, they have an application on your PS5 or your Xbox that allows you to play Netflix or watch Netflix movies. They're going to be like utilizing your hardware to be able to do that regardless. It won't be them actually creating their own hardware, I don't think.
All right, and then I guess last one that we really want to focus on in communication services, Activision Blizzard. So the sale I know is proposed, but given the recent announced acquisition of Activision by Microsoft, are we looking? And you just talked about it a little bit, but are we looking for like a specific exit price as it's nearing like the value it was rumored to be bought from? And I know you said we were looking a little bit at Nintendo. And how long do you think that would take, like maybe in the pipeline?
What the ad of Nintendo?
Yeah, if it is a viable investment, I should say.
We would want to be able to do it all within February, hopefully. That's what I think. When John and I were in the meeting with Professor Ko today, Professor Ko we were going over the details of the deal that we know so far. Something that I guess kind of eased my mind was the idea that because they were bought at a premium, Activision by Microsoft, they're essentially their like their time horizon, their investment horizon is supposed to be that premium. It's supposed to be that $95 per share. So we want to move fast, obviously, because the deal is going to be closing in 2023. We don't want to. We have no idea how that's essentially going to affect moving forward. The more time that flies by, I think the more time wasted. And we know that Kotick, who is, many can say as the root of all the problems that are happening currently with Activision, is going to be around until the deal's closed in 2023. But we also don't see necessarily any like proper catalysts that will like say that that Activision will keep going up. I want to say that the whole acquisition of Activision was kind of a lucky break for our portfolio. But in regards to like the development of their games and whatnot, this acquisition hasn't necessarily made it so that it's become faster in any of the development that they have. So getting rid of Activision would be sooner rather than later is the goal.
Okay, awesome. Thanks for all the insight. We'll stick with you guys. So we have Caterpillar and Steel Dynamics. We were told that they're both currently under review for potential sell. Can you tell us a couple of the reasons you guys are looking at selling them?
1 second, people are in my room. Hold on.
I can start. So I know, especially for Caterpillar, I forget the number, but they're having a lot of trouble, especially in China right now. They're pretty much just getting crushed by all their supply chain issues. I think it was like something around 20%, maybe a little bit lower, of their revenue is just getting absolutely destroyed right now because it comes internationally and in places that are getting really crushed by supply chain. So we definitely wanted to review it and just kind of understand how much or how longer that would take to settle, if so. Because I mean, I think we like the company as a whole, but we really have to come up with a consensus of how long is this going to last. I know Amir had concerns over housing permits and stuff like that as well. So as of right now, I don't think they're doing too hot. We really just need to come up with a timeline, we guess, and then decide either are we going to write it out or should we get rid of it in place of something else.
Awesome, good to know. And then for Steel Dynamics, I know we're looking to replace them with another materials company. Do you guys have any prospects for that one?
Not quite yet. For that we're still looking, but Steel Dynamics has been great, and so we think maybe the time has come. But it's been great for the portfolio in the meantime, and we're potentially looking for something else maybe to replace it.
Okay, yeah, and then moving over to Lockheed and Exxon. Lockheed, can you guys give us any insight, especially given everything that's been happening in Eastern Europe and Ukraine?
We want to keep it. We want to ride this out. It's unfortunate situation that's going on around, but we like Lockheed in general. And I don't mean to be insensitive at all or anything. It's more so that we want to keep the position because we do believe in general aerospace and defense, especially their efforts in space, will be something that will be called upon later on as the development of defense further develops. And one thing that we pointed out in our last meeting that we liked about Lockheed was that it also, similar to L3, is beefing up its cybersecurity defense tactics and services. We want to hold for that.
Cool. And then I guess last one, ExxonMobil. They've been doing great considering all the oil prices, and I guess you could say OPEC Plus actually sticking to their word. Are we really going to keep in this long term, or do we think it might be a good time to get rid of it given everything seems to be working its way?
Excuse me. We also actually decided that we want to at least hold Exxon. One of the conversations that the equity team has been having is perhaps even rotating out of healthcare into Exxon or even into REITs, as we kind of went over a little bit earlier. We think that as oil starts to, we don't think that the transition from oil to renewable energy will be as fast as, you know, the world wants it to be. And to keep up with that, I think that a lot of oil suppliers and OPEC in general is going to they're going to keep prices high because they know demand's there. And so we want to be able to benefit off of that as well.
Yeah, thanks for all the insight, guys. I know you guys have a lot of sectors, so let's head over to consumer discretionary.
So let's start with McDonald's. McDonald's is one of our top performer for the consumer sector. However, as we say, top performer today can be laggard tomorrow. So we have some issue with the company. They have higher than, as we all know, we have higher than expected global food and labor cost trend, also wage inflation, and McDonald's have low customer satisfaction compared to the other restaurant. So what is your opinion on this position?
Yeah, so I kind of agree with Am I unmuted? Yeah, I kind of agree with what you said, Tuan, about potentially selling McDonald's. So kind of what we're thinking about specifically for the President's Golf portfolio is swapping McDonald's for Starbucks. We do think that McDonald's currently does have low customer satisfaction, taking into regards their wage inflation, just with all the increase in pricing competition, as well as we do see that it could potentially arise another price wars, what they had back in 2016. And then another kind of catalyst that we're kind of projecting why we want to sell McDonald's is just a consumer demand to shift towards cheaper substitutes, such as like healthier alternatives to eat at home, just from my belief on McDonald's. Anything to add, John?
No, I agree. Same points about McDonald. And we think that there could be better opportunities. Like Chuan presented his investment thesis for Starbucks. So I think that could be a better alternative to McDonald's.
Yeah, and McDonald's stock was also down 5% month over month, comparing it to December and January. We also saw that they had a big price increase on some of their menu items, which just kind of goes back to the price war that they had in 2016. So definitely keeping an eye on that, but it's looking like a potential swap for Starbucks and McDonald's.
So next is one of our laggard, Hasbro. I personally do not see a bright future for the company. Like for now, children love technologies products more. They even love digital toy, like not something in their hand. And also the company is very seasonal. Q3 and Q4 already passed. So Q1 and Q2, the upcoming one is gonna look very sad. So maybe should we look for a replacement?
Yeah, we're the consumer team was discussing about this holding. So the company has a bunch of supply chain related issues, but most importantly, they lost one of their major contracts. So we think that's a strong, like a really, big impact to its fundamentals moving forward. So we decided that it'd probably be best to sell. Although the company is trading at really low prices right now. So we're just thinking about the timing of it.
Yeah, we're potentially thinking a sell for Hasbro and potentially adding Amazon in place of that. Talking about specifically the President's Scholars portfolio. Amazon did have a little bit of a rocky month last month, but we're keeping an eye on that, and that could be a potential buy for President's Scholars.
So let's talk about our worst performer, Chewy. So they down 60% from all-time high, and last month alone down 20%. So should we hold on to it because it down too much, or should we cut the loss and take the money back before it go down further for Chewy?
Sorry, I was on mute. I feel like, yeah, Chewy kind of has had a bit of a rocky time, even throughout even since we've kind of received the portfolio in back in July and August. I do feel like if we catch anything else in our radar that could be a bigger gain or impact to the portfolio than Chewy is, I think we're more than likely to take that into consideration. Chewy's a good stock, but if there's something better, that's what we're looking for.
So we talk a lot about the bad things. So we have one good thing is Amazon go down for 20% from its all-time high and down 8% last month alone, from 3,700 to only 3,000 now. So should we look to add more to it for equity and make a new position in President Scholar?
Yeah, I like Amazon. They kind of did have a rocky last month, as most of some of the tech stocks like Apple and Facebook or Meta platforms, with the expectation that there's going to be a rise in interest rates for this given year. So that kind of made Amazon a little bit more volatile than usual. But they are expected to enhance their digital advertising, which is expected to bring major revenues for the company in Q2 of this year. So if we are able to get that report in sooner rather than later, I think it's a potential buy.
For equity, we're still deciding on Amazon, but just I guess some risk that could come with increasing the weight is that they're expecting, or analysts are expecting, a decline in their earnings. So with slowing earnings growth and potentially, rising interest rates, that could place some pressure on the company. So we're just keeping an eye on that potential risk.
Anything else you guys want to comment on the consumer discretionary or consumer stable sector?
Let me see. We do have a few potential sells, and we're looking, especially if anybody else has any ideas, to kind of swap these, because we are trying to bring up the consumer sector. It's been a little underperforming the last couple of months, but Constellation Brands we're considering selling, Hasbro, like we mentioned, Carnival Corporations, Nike, and McDonald's. So we're considering selling those. And if anybody has any ideas, we're currently looking, but just to put that out there.
And besides Starbucks, what else do you guys plan to replace those sales with?
One of them is Starbucks and Amazon currently. Still looking for some potentials.
Okay, so we sell a lot, but we don't have much to buy.
That's the problem.
Okay, let's move on. We can move on. Can we move on to the next slide, please? We have a big position in Wells Fargo for both portfolio. And last semester, we talked about holding Wells Fargo. However, as I dig a little bit deeper, I think maybe it's not a good position. With the asset cap still going on, Wells Fargo will miss out on the growth of other banks during this economic upswing, and it can make a damage to the bank long-term competitive position. So should we sell Wells Fargo and buy a different financial company?
Yeah, so I could talk a little bit about that. And I think, yeah, I was also looking at the asset cap and just, I guess, their past performance. I believe we've had them since 2019, and they've only, I think the holding period returns are like something like only 9% since then. As opposed to Bank of America, who's we've had for, I want to say, less than a year, with an HPR of like 23%. I think this could be a time for Wells Fargo to exit the President's Scholars portfolio. I'm not sure, does equity have it as, I'm pretty sure they do not.
We don't have it in equity.
No, okay, yeah. So I think, yeah, this could be time for Wells Fargo to exit, especially before this economic upswing.
So we can talk about Citi. Citi had less rate sensitivity than peers. So that means that the bank will not benefit as much as the other bank. And its long history of disappointing shareholder, it's hard to believe that this time will be different. So as we look to sell Wells Fargo, should we take in Citi when we consider all the long time of disappointing shareholder? So should we make the swap?
Well, I still think that a lot of the reasons why equity bought Citi, like I think a lot of those catalysts still hold up, such as like their multi-year transformation, their loan growth, and upcoming loan growth and interest rates. Personally, I don't feel like Citi is the one to replace Wells Fargo right now. I think we definitely have to do more research to find something to fill that gap, but I'm not too sure. I don't really like Citi filling that gap right now for us.
So about MetLife is one of our top performer. It has tripled since the pandemic low, and it's been almost double since the time we buy it. So as I do some research, I see there is no risk to the company. The risks are equity market rally. I don't think it's gonna rally much. International research weekend, I don't think so. It's gonna get stronger, and interest rate gonna stay depressed. We all know it's gonna stay high, gonna be higher. So there seems like nothing wrong with the company. So is the expectation or price in? So should.
Sorry, I think cut out for me there. But yeah, that's a really good question. Should we take the profits now? And from when I investigated company, I saw that they make a good amount within investments, being that they're within an insurance, and that they made a 4% difference within the last 3 months, given the time period in the stock market. But I'm seeing some problems with this as they have about a 20% holding within Asia itself. And I feel like Asia it's gonna be a little harder coming out of the pandemic. It's gonna be taking a little longer than America's. So my thinking is to move to a company who's more focused within America itself, such as Ameritrade, who has 100% holding, or sorry, Price, which is 100% in the US compared to the 80 or not 80%, 60% from MetLife.
And do your team has any proposed trade for the sector?
Not yet, but me and James will be meeting shortly just to brainstorm some possible trades.
Just a question, do we still have an opportunity to buy more financial, as we all believe maybe it's too late? Is it really too late to buy more?
I don't believe it's too late to buy more, specifically in the REIT section. We're thinking maybe, as the PMs and I have talked about, maybe taking the proceeds from Nike, which is a small position, combine with some cash, and maybe a little bit taking from health equity, maybe through the health equity holding, and combine that into a REIT. But because REITs are so specific, whether you go for commercial or residential or other spaces, you just have to really figure out where do you want to aim and where do you want to target, and we're going to figure that out. So Jordan and I are going to have a conversation about that and seeing where we want to set our sights too.
Thank you. Yeah, we can move on.
Sorry about that. We actually cut that slide and combined all the industrial team sectors together. But that's all we've got for our news recap for this week. Thanks for joining us. And thanks for all the participation, y'all.